Okay, let's go ahead and get started. Get everything situated for you guys. As I said, we're going to have a theme today, the Great American Road Trip. Of course, Larry Adams with Raymond James helps put together this presentation. And we're going to go ahead and walk through some disclosure slides here, and then we will touch base on the 8 topics that we're going to discuss today to outline our views and forecasts for the economy as we conclude 2024 and we look ahead to 2025. The reason we choose the road trip theme this year or this quarter is twofold. So first, there has been a resurgence in families taking road trips. After a downward trend from the 1970s to 2010, the percentage of families expected to take a road trip over the next 6 months has increased from 17% in 2010 to 31% today. Believe it or not, road trips are back in vogue. Second, as Rascal Flatts says, life is a highway, and we added a little bit to that. Investing and life are like highways together. Both are long journeys that require planning, move at different speeds, are highlighted by unexpected turns, and often require adjustments along the way. Ultimately, you have to focus on your destination, and that, in a nutshell, is what investing is all about. And that's really what this presentation is all about this afternoon, giving our views on what to expect from the markets as we stand at several major crossroads. For example, are we headed for a recession, or will we achieve that elusive soft landing? Who will win the upcoming elections in November? And more importantly, how might that impact the economy and portfolios? Given the outstanding performance we've seen year to date in the equity and fixed income markets, the question is, can that momentum be maintained? These are some of the questions that we will answer as we go through this presentation over the next 30 minutes. Turning to the economy, we'll start our journey under the sunny skies of St. Petersburg, Florida. Although there has been a hurricane that's recently gone through there, it's good to know that Raymond James headquarters was not affected too terribly. This is, of course, home to Raymond James in St. Petersburg, Florida. Up until this point, the skies have remained sunny for the United States economy, which has been resilient and defied many economists' expectations of a recession. For example, if you look at the textbook, many indicators would suggest that we should already be in a recession, such as the ISM Manufacturing Index. Historically, this index tends to peak 16 months before the next recession. Currently, we are 42 months from the recent peak, and in fact, for 22 out of the last 23 months, it has been in a contractionary state. So why is this indicator less predictive? Because manufacturing has become a lesser component of our economy, representing only about 8% of our total economy right now. When you look at the Fed tightening cycle, how many times did you hear economists say that if the Fed raised interest rates to 3%, it would short circuit the economy? If they raised it to 4%, it would be disastrous. And if they raised it to 5%, we would be in a depression. The reality is that none of that materialized. The main reason is that both consumers and businesses are less interest rate sensitive. Consumers had plenty of money in their bank account because of fiscal stimulus, so higher rates didn't necessarily impact them immediately. Businesses were optimistic. When interest rates were low, they refinanced to shore up their balance sheet. When you look at leading economic indicators, historically, this indicator peaks at about 13 months prior to the next recession. Currently, we are now 33 months from peak. Why has it failed? I think it puts too much emphasis on the goods portion of our economy, not the services part, which is really a dominant part of the United States economy today. Because of all of these false flags, economists had to recalculate their estimates about the eventuality of a recession. For example, many economists were talking about the United States economy going into a recession 2 years ago, starting in the second quarter of 2022. But what happened? They had to recalculate. Then they thought that we would go into a mild recession starting in the second or third quarter of this year. So far, there's no evidence of a recession. What have they done? They've had to recalculate again. And now most economists believe this economy is going to have that soft landing. Now, why has the economy been so resilient? There are several reasons, but here are a few key ones. First of all, we've got healthy job growth. We've created about 370,000 jobs per month on average since the end of 2020. More jobs increase the overall spending power of consumers. Government support. Stimulus checks injected $1.8 trillion into consumers' bank accounts. Additionally, government spending through the Inflation Reduction Act and the CHIPS Act have helped in reindustrialize our economy. Third, reopening trade. As we emerged from the COVID-19 lockdowns, there was a surge in travel and leisure spending. We experienced the summer of travel revenge, with travel spending increasing by 30% since pre-COVID levels. And then fourth, corporate investment in AI, artificial intelligence. Recent investments in AI by corporations have also supported the economy. These factors have kept growth solid. However, going forward, we do expect growth to slow, but not turn negative. For example, second quarter GDP growth was around 3%. For the next 3 quarters, we expect growth to be around 1.5% before it starts to accelerate again as we move further into 2025. The bottom line is we believe that elusive soft landing will occur with GDP growth this year at 2.6% and next year at about 2%. What are going to be the drivers? I think it's going to be via the consumer and job growth. While job growth is clearly slowing from where it was, we still think job growth around 100 to 200,000 per month will continue to support growth. Historically, a recession doesn't occur until job growth turns negative, and we don't see that happening. Second, we believe AI spending by corporations will continue. We're still in the early stages of the artificial intelligence rollout, so companies will be investing to increase their productivity. Third, consider the major bills that have been passed: the bipartisan infrastructure legislation, the Inflation Reduction Act, and the CHIPS Act. A significant amount of money has been allocated, but so far only a small portion has been spent. The important thing to recognize is that about 80% of this fiscal stimulus has not yet been spent, and that will continue to support the economy over the next year or so. Now, growth slowing down to 2% is a good thing because 2% is what most economists consider the potential GDP growth of the US economy. This means the economy is in balance, operating at full employment with stable inflation. It's like driving. The most efficient speed for gas mileage is typically between 35 to 60 miles per hour. Consistently driving within that range balances aerodynamics and engine efficiency, leading to better fuel economy. Once you get above 60 miles per hour, fuel efficiency tends to decrease significantly, and frequent starting and stopping isn't good for fuel efficiency either. We think the economy is growing in that sweet spot, right along its potential GDP growth, which is represented by this blue line. If it continues to do so, it will help elongate the longevity of this expansion. Looking at historical expansions, we believe we are in the phase of the business cycle, that phase of the business cycle. After a recession, we've had a recovery where we've regained all of the growth lost during the recession, and now the economy is expanding. This expansion, as of today, is in its 14th quarter, and we've increased our economic growth by about 12%. Historically, when you enter an expansion, it lasts about 20 quarters on average, with GDP growth increasing by about 24% since 1982. The most recent expansions have been longer, about 28 quarters, with GDP growth of about 27%. If this ends up being a typical expansion, there's still a lot of runway for the economy to continue growing, particularly if it continues to grow at or near its potential GDP. Turning to monetary policy, one of the main dynamics likely to sustain this expansion is the Fed cutting interest rates. We wanted to visit the Fed building in Washington, D.C., which is an absolutely beautiful building with an elegant marble exterior facade. While the Fed building might not be on your bucket list of places to visit on a road trip, it is actually the most watched and anticipated central bank in the world. Last month in September, the Fed finally started to cut interest rates after being on pause for 14 months, the second longest time it's been on hold. The Fed cut interest rates by 50 basis points. What's important to understand about the Fed, about what the Fed did, is that they're cutting interest rates today because they have the ability and they're being proactive. This is quite different from when the Fed is forced to cut rates. For example, the Fed had to cut rates during COVID because the economy was shut down. During the great financial crisis due to the housing market struggles, and in the early 2000s because of the tech bubble burst, the 9/11 attacks, and the resulting recession. We think this rate cutting scenario is more like what happened in the mid 1990s and mid 1980s, where the Fed cut interest rates without a recession on the horizon. The Fed is cutting rates as an insurance policy to preserve economic expansion. If the Fed is successful, like they were in the 1980s and 1990s, this could extend the expansion for a significant period of time. After we get through this small patch of economic slowing, I think you'll hear a lot of people refer to it as mid-cycle slowdown as the economy starts to accelerate towards the back half of next year. Now, the primary reason the Fed will be able to cut rates is that inflation remains on the downward path towards the Fed's target of 2%. I think you will continue to see inflation decelerate. Look at what's happening this week with major retailers like Walmart, Target, and Amazon offering all kinds of deals. This indicates that prices of goods are being contained because these promotional activities suggest price cuts. If you were watching football games this week, in addition to political ads, you likely saw many promotional ads for restaurants. This trend will likely keep dining out prices more muted than we've seen in the past. I believe inflationary pressures will continue to decelerate to the point where the Fed wants them around the 2% level. It's important to note that the Fed is focused on the pace of inflation going forward, not the overall level of inflation. The Fed cannot erase all of the inflation that we've experienced around COVID and beyond, where inflation increased by about 20% over these years, averaging 5.6%. However, year to date and looking ahead to next year, inflation is expected to be much more tame, around 2.1%. This is what the Fed is monitoring. To recap, here are just a few examples. Housing market and rental prices. Since 2019, they've gone up 25%, but over the last year, rental prices have actually decreased by 1%. Grocery prices. Since 2019, they've increased by 26%, but over the last year, they've only increased by 1%. And price of stamps. Since 2019, the price of a stamp has gone up 55% to 73 cents per stamp. But just 2 weeks ago, the US Postal Service announced no change in the price of a stamp come January. The point is, the Fed can't change what's already happened, but when they look at the current pace of inflation, it appears to be well contained. Now, why is it important for the Fed to cut interest rates? First of all, it should help the interest rate sensitive parts of the economy, such as vehicle sales, household durables like washers and dryers, and the housing market. According to a survey, interest rates are a significant reason why people are not buying these items at this time. In fact, it's at a 40-year high for people saying that interest rates are prohibitive for purchasing these goods. If the Fed continues to cut rates and they calm down, It should unlock some of the potential demand for these goods, helping the economy move forward. Currently, small business borrowing rates are around 9 to 10%, significantly higher than in 2020. This makes it expensive for small businesses to expand. Lower rates will help them grow, and it's important to remember that small businesses are critical to our economy, accounting for over 55% of hiring in the last 10 years. From a government perspective, lower interest rates are also beneficial. Over the next 3 years through 2026, 55% of all government debt outstanding is going to mature, and it needs to be refinanced. Much of this debt has an interest rate around 2%. If it were refinanced today, it would likely be at 3% or higher. Higher interest rates makes it more expensive to afford this debt, which would eat into government spending as more money would go towards paying interest on that debt. When it comes to our forecast, we are not as aggressive as the rest of the industry. The dark dashed line represents where we think interest rates will move, while the gold bar shows the consensus. We believe that the Fed will cut rates 2 more times this year by 25 basis points at each meeting. By the end of the year, we expect an additional by the end of next year, I expect an additional 4 cuts, bringing the Fed funds rate down to 3.4% from the current 5%. Some people question whether we are worried about differing from the consensus. Our point is that the consensus hasn't always been accurate. For example, from 2010 to 2015, the consensus expected the Fed to raise rates, but they stayed on hold. More recently, the consensus has been predicting rate cuts for the last 2 years, yet the Fed continued to raise rates and then remained on hold for a significant period of time. We are not concerned about being different. We focus on our fundamentals and what the economy needs to avert a recession. As I always say, the number of rate cuts next year is less important than their impact on the economy. If the Fed can navigate and engineer a soft landing, it will have a very different impact on the fixed income and equity markets compared to a recession. Turning to the election, which is less than a month away, there are 3 things to remember. Number 1, it's going to be a close race. That's why we decided to drive through the blue state of Pennsylvania, Michigan, and Wisconsin. Number 2, the winner doesn't necessarily have a statistically significant impact on the economy or markets. Just because a Democrat or a Republican wins the presidency does not provide a clear blueprint for how the economy or financial markets will react. There's been a lot of variation under different scenarios. And number 3, while politics are important, it's not the most critical factor in our analysis. When we look at our 10-point dynamics to form our view, politics actually ranks number 8 of 10. More important factors include the state of the economy, the Fed's actions, earnings growth, sentiment, and valuations. These are far more crucial in shaping our outlook than who is sitting in the White House. Turning to fixed income, we head west into the states of Iowa, Nebraska, and Kansas. Just as the agricultural production of these states helps sustain our economy, fixed income is a staple part of your portfolio. Bond yields are significantly higher than the 20-year average and dramatically higher than the lows during COVID. Many bond investors have compared today's bond market yields to Iowa's Field of Dreams because people didn't think yields could rise this high so quickly. From a diversification perspective, bonds now have a negative correlation with equities, meaning they don't always move in the same direction. This is important because it adds balance to your portfolio, providing you diversification. Now let's look at the reaction of the yield curve. This chart breaks down the reaction of the yields into 2 time periods. The navy boxes represent the time when the Fed is on pause between the last hike and the first cut, and the light blue shows what yields do 12 months after the first cut. In longer duration bonds, most of the move lower in interest rates occur when the Fed is on pause. When the Fed starts cutting, you see a significant downward movement in short-term yields. This greatly influences how we think the yield curve will change over the next year. The dark blue line represents where the yields are today. And the dashed blue line shows where we expect yields to be 12 months from now. We believe longer duration bonds will be relatively range bound with the 10-year treasury around 4%. However, we expect a significant decline in short-term bond yields because the Fed controls the shorter end of the curve. As they cut rates, it should drive the lower end of the yield curve down. One question I often get is whether the huge amount of government issuance will likely drive interest rates higher. Some people believe this supply will push long-term interest rates up to 6% or even higher. We don't share that view. We monitor it, but we don't think that it will happen because there's no current evidence that increased supply is impacting interest rates significantly. There are two main reasons for this. First, despite the government issuing a lot of debt, demand has been strong. Retail investors, foreign investors, banks, and insurance companies have been buying these bonds. One indicator we use to gauge the health of the bond market is the bid to cover ratio, which measures the demand for government debt. Currently, there's more than twice the demand for the debt than what the government is issuing, indicating a healthy demand. The light blue line on the chart, which is a rolling average, is moving higher, suggesting a strong appetite for treasuries. We watch this closely, and if the bid to cover ratio starts to trend lower, it would be a concern. But right now, it remains very healthy. That's why we believe the 10-year treasury yield will stay around 4% for the next 12 months. Now, as we drive further south, we're going to enter oil country. As everyone knows, Texas is the largest oil producing state. However, believe it or not, Lea County in New Mexico is the largest oil producing county in the United States, sitting above the Permian Basin. The production of oil supply is a big part of this story because oil is a commodity which is driven by supply and demand. Over the last 10 years, U.S. production has increased by approximately 4 million barrels per day. In contrast, Saudi Arabia, in an effort to keep prices elevated, has cut its production by about 1.2 million barrels per day. The point is that OPEC has tried to implement supply cuts. The United States has more than offset those cuts. Today, global oil production is essentially at a record high. How has the United States been able to increase its production? The main reasons are increased efficiency and technological advancements. For example, in 2019, there were 677 rigs, but today there are only 488 rigs, a 28% decrease, yet our production has reached an all-time high. Our target for oil is $75 per barrel over the next 12 months. At this price, production is likely to continue increasing because it remains profitable for producers. The break-even price for existing wells is $39, and for new wells, it's $64. With profitability at $75 per barrel, we expect more oil production from United States producers. Regarding the energy sector of the equity market, we rate it as an overweight sector. The primary reason is its attractive valuations, especially considering the amount of money returned through shareholder-friendly activities like dividend yields and buyback yields. When combined, these yields are far superior to those of the broader S&P 500. In fact, energy is the #1 sector in terms of combined dividend and buyback yields, which should help it remain an attractive area within the market. Turning to the equity market, we find ourselves in Southern California enjoying the perfect weather conditions of San Diego. If you look at some statistics, San Diego has 266 sunny days a year, well above the national average. The average temperature is 70 degrees and it rarely experiences hurricanes or tornadoes. Just like the great weather conditions in San Diego, the conditions are set up for the equity bull market to be favorable as well. These are the 5 things to keep in mind. Number 1, I don't think there will be a recession. When the Fed starts to cut rates and there's no recession or soft landing, you get much better market performance compared to a recession scenario. We believe we will follow this positive trajectory. Number 2, we expect earnings to continue moving higher as the economy accelerates. We anticipate earnings growth for the S&P 500 to be around 10% next year. This is important because we believe the equity market is fairly valued currently. To achieve higher prices for the S&P 500, earnings growth is essential. We believe this growth will materialize and drive the equity markets higher. Third, we expect inflation to remain contained within that 2 to 3% range. Historically, when inflation is in this range, it supports the highest market valuations. Fourth, there is significant amount of cash on the sidelines, about $6.5 trillion in money market accounts. And as the Fed starts to cut interest rates, this money will likely seek other opportunities in the market, with a large portion potentially flowing into that equity market. Additionally, businesses continue to enact shareholder-friendly activities. We expect dividend growth to be around 5% next year, and it could approach 10% the following year. This trend for buybacks is also on the rise. Both the dividends and buybacks provide long-term support for the equity market. This is why we forecast that 12 months from now, the S&P 500 will be trading at 5850. While our upside is more muted than in the past, it is consistent with historical trends. Tomorrow, October 12th, marks the second anniversary of the current bull market. Historically, the third year of the bull market sees more muted returns and a reduced probability of a positive year, leading to increased choppiness. One reason for this muted performance is that by the end of the second year, many investors have already bought into the rally and are confident that the market will go higher. Unfortunately, bullish sentiment is historically a contrarian indicator. When more than 50% of respondents in the AAII Investor Sentiment Survey believe the market will go higher, the market tends to be flat 6 to 12 months later. In the near term, we expect some volatility around the election. Historically, during open election years with 2 non-incumbents, the market tends to trade off going into election due to uncertainty. From now until election day, the market has historically been down about 1.5% on average. In the last 6 presidential elections, the market has been down between now and election day. The good news is that once election day is over, the market historically tends to recoup those losses and move higher. As we enter our final stretch, we cross over the most photographed bridge in the world, the Golden Gate Bridge, right in our backyard. This reminds us of the goal of asset allocation, and that goal is to build a bridge from your investments today to a sustainable future, maximizing your ability to attain all of your goals and objectives. Ralph Waldo Emerson once said, "It's not the destination, it's the journey." However, I don't think he ever managed portfolios. Personally, I disagree with this statement when it comes to managing portfolios, because we need to have both the destination and the journey in mind, as both are critically important in successfully managing a portfolio. When constructing a portfolio, we want you to consider using the checklist below to devise the strategy. Choose a co-pilot, that's the first thing. Someone to guide you through the process. That's why we're here, to provide you with the knowledge and experience you need to navigate turbulent market times. Number 2, determine your risk profile. Decide whether or not you want to be a defensive investor with a lower risk portfolio or a more aggressive one with volatility but potentially greater returns. Number 3, customize your journey. Plan your investment path and be ready to make adjustments if necessary to reach your financial destination. Number 4, pack snacks. And calories don't count on road trips. Just like on a road trip, you need to be patient and avoid making rash decisions. Don't let emotions drive your investment choices, as emotionally driven decisions often lead to subpar performance. And number 5, choose your listening material. Focus on information that aligns with your long-term goals and objectives, and try to block out all of those distracting headlines. This will help you have a more comfortable and enjoyable investment journey. Remember, our journey resembles the typical path of the market with its ups and downs, but ultimately you reach your destination. It's unrealistic for markets to move in a straight line, like flying a plane from St. Petersburg to Seattle. A meandering route is more realistic for financial markets and your portfolio. At our endpoint, we arrive in Seattle at the iconic Space Needle. And just like the Space Needle, a solid portfolio needs to be built to last. Did you know that the Space Needle can withstand winds up to 200 miles per hour? It's a robust structure. And from the observation deck, you can see 20 miles into the distance, from the mountains to the water to the city itself. This broad perspective is essential in managing your portfolio. Keep looking out into the distance to ensure your goals and objectives remain in the right perspective. To give you some perspective on where the Dow and the S&P 500 could go in the future, we've done some analysis. While there are no guarantees due to market volatility, and I'm not in the business of predictions, looking at the average return of the S&P 500 over the last 10, 20, or 50 years, it has been just over 8.5%. We can make some projections with those numbers. Assuming the S&P 500 continues to grow at this rate, it could potentially reach around 9,300 by 2030 and 14,000 by 2035, up from its current level of about 5,700. Similarly, the Dow, which is currently at 42,000, could approach 70,000 by 2030 and exceed 100,000 by 2035. This illustrates the power of compounding interest that we all talk about. Remember, our goal is to create a plan that allows you to accomplish your goals, and more importantly, one you can stick with during periods of volatility. I hope you found my fourth quarter town hall informative. If you have any specific questions, please feel free to reach out. And before you take off for the weekend, I'm just going to give you a little piece of fun. Obviously, I have a couple disclosure slides for you. And then this is a road trip my family took in 2019. We went all the way from California up into Pacific City, Oregon, where we did some fishing and visited the Tillamook factory, and then we came back. So fun times on a road trip. Hope that everybody has a wonderful weekend. Don't hesitate to reach out with questions, and thank you for your time this afternoon. Take care.